We have to get wages up. I mean, the way you fix this affordability problem isn't by bringing prices down. That's actually like if you look at those kinds of events historically, they're not fun events for anybody. What you need to do is you need to keep wages rising.
No, I think prices should come down so long as it still can. So long as companies can still maintain profitable margins. This idea that deflation is bad. Everybody looks like, oh, look at 1929 and 2008. It's like, yeah, those events were bad. People became suddenly unemployed. But also look at how deflation has actually been the law in the technology industry. It is so long as a company can provide products and services at a steady declining rate, providing more and more value to consumers, but do so profitably. Yeah, that's really the magic formula.
I'm not so worried about companies making less money because the price of their products goes down. I think that if you took the value of the housing market in the U.S. and dropped it by 20%, I think that reflects trillions of dollars in the pockets of potential spenders.
So, the South Sea Company in 1711 was launched to take advantage of this East India Company craze. I forget who the founder of the South Sea Company was. Some French guy, if I'm not mistaken. Yeah, let's see here. The South Sea Company was a British joint stock company officially established in 1711 by an act of parliament. As a public-private ownership, its primary purpose was to consolidate and reduce Britain's national debt. Yeah, that's right. So it was basically this scheme put together by this guy named Robert Harley to he basically sold the king on creative financing. He figured out a way. He promised to figure out a way to refinance Britain's debt. So what he was going to do was sell shares of his company. And then through the blessing of the king and parliament, he was going to then take the company and absorb the national debt. And it was just this scheme that made absolutely no sense. When any logical person like Sir Isaac Newton was pretty logical, should have looked at it and thought, no, this is not, the math isn't mathing. How can you sell a bunch of stock and then use the proceeds of the stock to refinance the debt of the nation? So they were basically he was going to buy the debt and then resell the debt at a lower rate or something like that. It made no sense. But the company ultimately didn't do anything. So he just gave it a generic name of the South Sea Company. Anyway, we'll talk about it later. But the South Sea Company actually didn't do anything. So unlike the East India Company that engaged in a lot of trade and actually provided a valuable service in the spice trade and just shipping in general, they brought a lot of goods between Asia and Europe and generated a lot of value for a lot of people. And that's the reason the stock kind of took off. But the South Sea Company had no such fundamental business. It was just labeled the South Sea Company. They didn't do anything. It was just, the world's first well-known example of creative financing, but then everybody, it kind of tulip mania took off. The madness of the masses. Everybody got caught up in it and was buying and selling shares of the South Sea Company. And even Sir Isaac Newton, he bought it, floated it up. So per the story here, let's see. Initially profit enhancement. He sold most of his shares. Go ahead.
Well, here's what's, and we probably should just maybe circle back to this a little bit later. But what's interesting to me in this is if it looks like the South Sea Company was essentially granted a monopoly on trade in exchange for assuming a large portion of the national debt from England. So this company comes into existence, goes to the British government or the English government, whatever it is, says, hey, we'll own a lot of your debt in exchange for the permission to have a monopoly on this trade. And so it it's very akin to some of these things going on today, because if you look at a lot of what's been going on today, we have a lot of government intervention. Like all of a sudden, the U.S. is now selling HB20 chips from NVIDIA into China, but the U.S. wants 25% of the revenue. Intel, is getting an investment from the government. So like, this is kind of, to me, it's like it's another one of these examples of like state-sponsored enterprises, and kind of like today. I mean, I would say as an advisor, since like the Intel deal, for whatever reason, people like I guess clients seem to think that it's a good thing that the government's involved in these businesses, and I'm not. I guess from my perspective, I don't know that the government is the best operator of a business. So like, I'm not quite sure if the investment theory should be like government is involved, this is a good thing. But clearly, this is what happened before. So in what I find interesting about Sir Isaac Newton's case is he kind of got it. So he initially buys in the early 1700s, and as the price goes higher, he actually realizes this is irrational. Like this doesn't make sense.
And then he sold.
So he sells. And it's just such a testament to how emotional investing can be.
But then he bought back in.
Well, that's the problem.
Yeah.
How much can you stand to watch your neighbor make money when you're not, before you finally say, you know what, I'm the dummy here. And so that's exactly what happened here, right? He gets out only to sit on the sidelines while everybody else is making money hand over fist, to then eventually capitulate and get back in right before it crashes. and so he loses a ton of money, and it's a terrible idea. And one of the world's most logical protagonists is duped. So it's just a good reminder that like no matter who you are and no matter how much logic you have, I mean, we talk to clients all the time that they're really smart people. I mean, it's investing is one of these weird things where almost the more you think you know, the worse you are at it, because trying to pretend like you can predict the future is just not an easy game. And trying to pretend that you have full control over your emotions, also not an easy game. So anyway, I love this. I just think so.
Yeah. All right.
What's been going on?
Well, a lot. I took off the past few days last week and went to Las Vegas, Nevada, and helped Vince Valeriano. He's one of our advisors, out in Las Vegas. If anybody's looking for a good advisor out in Nevada, give Vince a call. He's a great guy. So I got to visit his office and do his recording. So it was myself and my wife went out there. We got to go hiking in Red Rock Canyon. Have you ever been to Las Vegas?
I've been to Reno, Nevada.
Yeah. So Vegas is very weird. Vegas apparently means the springs in Spanish. And you go there and it's as dry as a bone. So you wonder where it all came from. But apparently, I guess a long time ago, that used to be kind of a lush oasis. And of course, now where there once was an oasis, there is now a sprawling city. But I think the biggest appeal of Las Vegas is actually not the city itself. Of course, we drove down the Strip and everything and saw that. It's just, it's just madness, honestly. But we ended up going to the outside of Las Vegas. You got things like the Hoover Dam, Lake Mead, which is really fascinating. But then you got one of the most famous spots, hiking spots in the nation is actually Red Rock Canyon. So you got a bunch of people that go up there for rock climbers. Well, interesting stat about Red Rock Canyon, after 365 days, guess how many of those days first responders are called out to that area?
Oh gosh. Is it a lot?
240.
Wow.
240
like
days.
2/3.
Yes. And we were talking to the guy that was there because we noticed there were like helicopters flying. Because one thing about Vegas or just Nevada and the West in general that you don't get here in the Midwest is just how far you can see. I mean, you at any point in the city, you can kind of see like 12 miles out. It's pretty wild because it's just so flat and you got these mountains everywhere. So, it's possible to see clear across the city, and you can see like these emergency responder helicopters going out like, 15, miles away. And we were just noticing that and we're like, oh, it's going out the Red Rock Canyon. I wonder what happened. And so when we pull up to the gate, we ask the guy like, hey, is that, what sounds something crazy happened? He's like, that happens every day. He's like, people think this is just a leisurely walk. He says, people out here, there's multiple fatalities that happen every year because, people try to, do things that they shouldn't be doing.
Ugh.
And, we went on a trail. I think it was called the Tanks. It was called the Tanks or something like that. Really cool trail. It went out like 1.1 miles, and then you went out to this cliff face where you could see the entire city. It was pretty serene. But there was this real sketchy part where you had to like climb on this like 2-inch ledge and kind of lean against the rock wall. And if you made a misstep, you were in the drink, man. You were falling probably 15, 20 feet. You wouldn't die, but you would have broken some bones.
Oh my gosh.
Yeah. So,
you're more adventurous than me.
Yeah. Well, we were hiking with a couple people. Nick was one of my friends. It was like, nope, not going. I'm like, so you came all this way and you're not going to go see the view. But, my wife did, she did go with me and we loved it. So it was a lot of fun. Glad to be back though. I will take, the weather that was out there perfect. And people said, well, how is it to come back to Cincinnati? Because we flew into the snowstorm. We got like 6 inches of snow and like 8-degree weather to follow. And the roads were awful. And I'm driving my WRX, which has pretty much like summer tires, like slicks on it. So I'm sliding all over the roads. People are passing me in these like 4x4 trucks, and of course they're going like mad. But I'm sliding all over the place because my tires stink. But anyway, we made it back, and people are like, "Ari, I bet you're sorry that you had to leave." It's like I will take 8-degree weather in my bed any day over perfect weather in paradise in someone else's bed. I'm such a homebody, so I really am not a big traveler. Although I did enjoy the scenery. It was pretty cool. For anybody who goes out to Las Vegas, if you're not much in for the nightlife, go out to Red Rock Canyon. It's pretty incredible.
Well, I traveled to birthday parties. We did birthday parties on birthday parties the last 2 weeks. I've just like this time of the year.
You had a birthday in your family recently.
Yeah, my daughter's birthday was recent, but like for us, between Thanksgiving and Christmas, between birthdays and holiday and travel, I mean, it's a little crazy. And then trying to wrap up the business and all of those things before year end, make sure all of the clients are taken care of. It's, a bit of a marathon. So
yeah, birthdays are they're an issue. So what's your protocol? Do you stay for the birthdays? Because back when I was a kid, man, we had birthday parties, but my mom would just drop me off. She'd just drop me off and then, I'll see you later in like 2 hours, But what I've noticed is that parents are kind of there.
We stay.
Yeah.
Yeah.
Stay.
So we this weekend, I took my daughter to a birthday at one of these kind of like a Dave and Buster's, like a play place kind of thing. And the kids all bowled and then they played games. And then what I will say that was a lot of fun was I was able to participate in the laser tag. So all these kids, and mind you, my daughter's like 5. Okay. They're in kindergarten. And we all, like, there's this guy that's running the party and everybody eats the pizza. And then he says, all right, it's time to go to the laser tag. And so there's this room and it's all dark and all the vests are lit up and we line up outside of the door and all of a sudden there's like 20, 16-year-old boys. And like all of us are there at this birthday party for like these 6-year-old girls. And we're like, are they really going to let, a bunch of 6. So anyway, so laser tag has been changed a little bit. So I don't know if this is just like when I was a kid, it was more exciting and maybe I didn't know it's kind of like Halloween as a kid and your whole neighborhood transforms. But like, so we go in there as a parent chaperones, which was a good excuse just to put on a vest. And but I kind of felt weird trying to shoot at little kids. In vests. I mean, this was just like, it sounded cool getting in and playing laser tag at first. And then I was like pointing this thing at a kid. And this just feels weird. Mind you, one of the other dads that was there, like, won the whole thing. Like he was number, like me and one other dad.
He went full Rambo.
He just like took everybody out. I mean, it was, so anyway, the rules were like, you can't run, you can't jump. And it was this kind of big empty room with basically some partitions put up in it so that it felt, I mean, it wasn't quite what I remember.
I'll be honest, it sounds like it sucked.
It was fine. I mean,
Yeah.
it was my daughter had a good time, and
Good. Well, that's what matters.
everybody was safe, and I think we all had a good time. But anyway, we drove home in the snow after that, and then proceeded to try to stay in over the weekend. So
that was on Saturday then.
That was Saturday. Yeah. Anywho, now back to work. Markets are doing their thing. It's definitely been an interesting year.
Mm-hmm.
And we wanted to take some time, so maybe we'll do the intro really quick here. So welcome to the Money Alchemist podcast. I'm Brent Gargano.
And I'm Ben Jones.
And we wanted to take a little bit of time on this podcast to talk about reflect back on some of our 2025 predictions from last year, and then start to think about what do we think about 2026, talk through maybe some positioning moves that you could be doing to make smart decisions with your money, and then look forward to maybe a story or two. So anyway, Ben, what did you have from our predictions last year?
Well, I come out with a newsletter every year, and I think I'm going to do it this week, where I come out with 5 predictions for the following year. And the 5 predictions I had for 2025, 4 of them happened. So here they are in order. One of them was, remember Doge? Everybody was all hot about Doge. Elon was coming in with the chainsaw, and everybody was afraid that he was going to axe all these programs. Well, it ended up for lack of a better term, it was just a wet fart. Nothing happened. So I predicted government spending does not decrease. In fact, it didn't. Deficit spending slowly declined, but deficit spending implies increased spending. So government spending actually still increased. AI, I also predicted the AI human counter-revolution would begin. So what I meant by that is that people would start pushing back against the application of AI in industry. And you're seeing that play out mostly in conversations with people. I see it on X and other social media platforms where people are complaining about how their employers forcing them to use AI. So people are sabotaging, the application of AI. And you're also seeing industry, especially the entertainment industry, fight back against it because of a copyright violation. So you're seeing that happen a little bit. I think we're going to continue to see that as a theme. Humans just don't want to be supplanted by AI, and there's a natural aversion to that. Mostly because there's natural aversion for humans to adopt the unknown. And I think AI, there's a lot of unknown there. Another prediction I made, which was a bold one, nobody really bought me on this, but I ended up being right. And that is, I said crypto assets would suffer a bear market. I didn't say they would correct. I said they would suffer a bear market. And sure enough, they've fallen like a rock over the past couple of months. So it took a little bit. It took to the end of the year, but I was right on that call. And then lastly, and this did not happen. Well, it's not lastly, it's second to last. And that's the Fed raises rates.
Yeah, we knew you weren't right on that one.
I was kind of wishful thinking. Now, I should have rephrased that and said the rates will stay higher for longer than people expect.
That's kind of been the theme since 2022.
Yeah. Now, the Fed did ultimately cut rates. They didn't raise rates. I think that the Fed is not too tight. Of course, we're not going to talk about that, right now, because that's a whole nother conversation. But I was wrong on that. The Fed actually did not raise rates. They did ultimately cut rates. And the last prediction I made, which I ended up being correct on, was I felt U.S. equity markets would correct before moving higher. And sure enough, that's what we saw. Equity markets, I think the S&P 500 at its worst point was down 15%. Sometime
it depends
in the
on
spring.
where you manage it from. It was like 25% from the peak.
Yeah. Year to date, it was down 15% sometime around March or April. I can't recall the exact date.
Tariff tantrum.
Yeah, the tariff
The big,
tantrum.
beautiful chart.
But then
Howard.
but they've moved higher. So last I checked, S&P was up, 16,
18% on the year
to date.
roughly.
Yeah. So, doing quite well. And I think we're going to probably end the year strong, with a Santa Claus rally, most likely. But, so 4 out of 5, not too bad, I would say. Some of them were bold. Some of them were kind of not. But, we're going to use that as a segue to our 2026 predictions.
Well, hold on. So let's like, since you're the 4 out of 5 is pretty good, I guess. We'll pat you on the back this time. But
well, the year prior I was 3 out of 5, so I'm improving.
So, but let's talk a little bit about each one of these. So, government spending.
Mm-hmm.
I think this one's a big deal because Trump kind of ran on like getting spending under control. Doge kicked in. But Trump, we all know from Trump's first term that he liked to spend money. And so we're seeing more of that. And you mentioned the deficit has been reducing. How much of that was because of tariffs?
Well, tariff revenue so far is year to date is like $200 billion. That's what it's estimated to be. Now that amount is, somewhat fudgy because no one quite knows the precise amount. But I've seen estimates, that range from $2 billion. If you believe, I saw a video where Trump said, they've collected 18 trillion.
Yeah.
Which I was like,
greatest ever.
What? Yeah. Greatest ever. I don't think your math is correct.
Well, but these are tied up in the Supreme Court right now, right?
And it's not tied up in the Supreme Court. So the Supreme Court, so there have been several retailers, Costco being one of them, brought a case against the administration for its use of the International Emergency Economic Powers Act, which is the law that is being used to levy these tariffs at the executive level. So, and the challenge,
this is basically how Trump's been able to do this without Congress.
Yes. And the challenge is tax policy, per the Constitution, should be made or established by Congress, not the executive branch.
Yeah, Congress has the power of the purse.
Yes.
I think is what we say.
Yeah. So, we've got this big giant question going into 2026 of, will these tariffs stand or will they not? That's actually going to be one of our 2026 predictions. So we're going to pin that for later. But that's what's going on is, the Trump administration is just unilaterally like establishing tariff policy based off this one act. So whether or not it's constitutional is yet to be determined. So the Supreme Court did agree to hear cases for and against. They did that in September. I think they had verbal arguments in November, if I'm not mistaken. And then the hearing is kind of tentatively scheduled for summer of next year, so late summer. So we'll
oddly enough, I shouldn't say oddly enough. Interesting timing, being that it'll be 4 or 5 months. So upcoming midterms.
Yes,
as we go into that. So, it'll really put the pressure. I think we'll see the screws get tightened on a lot of the Republicans in Congress as they have to really articulate their position on these tariffs and try to support these things to their constituents. What do you think about the interest rates? One of the things that, maybe as a lot of the listeners may already know, maybe not, but just as a recap, last year in September, so September 2024, the Fed started dropping interest rates, and the Fed doesn't control all interest rates. They control short-term interest rates.
Well, they have tools to control the full spectrum of the yield curve. So, what you're seeing now with the federal funds rate, which is their key rate, and that's the rate that banks charge one another for overnight lending, which they need to do to, meet certain liquidity requirements, but also, just to raise capital for their operations and whatnot. So think of the federal funds rate as the interest rate banks get, just like your bank gives you an interest rate. The banks get an interest rate as, established by the Fed. And the way the Fed controls these things is through open market operations done through the New York Fed branch. And how they do that is they basically either flood the market with T-bills or commercial paper or anything that the Fed Fed buys and sells. So they increase the availability of supply to decrease the rate. So basically the Fed engages in liquidity operations to reduce the rate. That's how it's affected. So the Fed can do that on the short end, but they can also do it at the long end. So if the Fed wants to, it's called quantitative easing. So if the Fed wants to artificially lower long-term interest rates, then what they'll do is they'll start increasing their balance sheet. That's what it's called, where they basically create cash and they buy long-term bonds.
They're buying long-term bonds.
Yes, they become a buyer of long-term bonds in the open market. Now, there's a limit to how much that can be done. But that's what was happening during what we call the ZIRP years, the zero interest rate policy. That's why we had 10-year treasuries at less than 1%. It's because the Fed was just gobbling them up. And it got to the point where the Federal Reserve balance sheet was astronomical. And they can do the opposite. They can flood the market.
They let the balance sheet run off.
Yeah, they can let the balance.
And that's what they've been doing for the last few years.
Yeah, well, how they've been doing it really, which kind of has a neutral impact on interest rates, is they just been letting the bonds mature and they don't do anything with it. It's just the cash gets evaporated. So the Fed is in a nice position where they can literally create currency if they want to.
Well, I think part of, there's a reason I'm asking these questions. I know we're going to get eventually to our 2026 predictions here. And I think a lot of this stuff helps lay the foundation and paint the picture for why we believe what we believe and kind of where that have gone. And you and I have some slightly differing perspectives, but one observation that I've made, I'll just say this: since last September, as we just pointed out, Fed adjusts the short-term interest rates. Now, I'll just use the longer-term interest rate that I'm going to use for this example is the 10-year Treasury rate. So what kind of interest would you get if you lent your money to the government on a 10-year basis? Now, this is the same rate that mortgages price off of. And, one thing that's become huge in the zeitgeist the last couple of months is affordability. Specifically, housing affordability has gotten crazy, right?
Yeah.
And so the government, because I guess we've all of a sudden decided that the government is in charge of managing prices in the free market economy, right? And so the government is now tasked with trying to figure out how to make housing more affordable. So we've seen pitches for 50-year mortgages, which I don't think make a ton of sense. And then, of course, you've got a lot of people pounding the table that the Fed needs to drop the interest rates, make things more affordable. And I don't want to minimize the impact of dropping the interest rates. There's a lot of money in the system that is borrowed on short-term basis or on the Fed funds rate. But when it relates to housing in this example, really mortgages price on the 10-year bond rates. And so here's the problem is since last September, the Fed has lowered short-term interest rates by 1.75%. We're almost 2% lower in short-term rates than we were, a year and 3 months ago. The 10-year Treasury yield, the one that we price our mortgages on, is actually up like almost 0.5%.
Yes.
So it is troublesome when you look down and you go, okay, what is the Fed supposed to do? Now, I agree with your point. They've just in the last Fed meeting, they've reintroduced this idea of quantitative easing.
Yeah. Well, the Fed committed now this quantitative, they call it not QE.
Who is they?
They being the plumbing experts. There are these people out there that are their sole.
Is it an official title, plumbing expert?
It's not it's unofficial for sure. But there are people that I follow on like Substack and whatnot, where they really are into, like, they're experts on central bank plumbing is what they call it. So like we're how the capital flows through these central banks, and these people are fairly brilliant actually. Like the central banking is such a deep topic, and it is truly like an Alice in Wonderland rabbit hole, where you can go super deep and ultimately you don't find any truth. It's all like cyclical financing. The best way I can describe it is I heard someone on a joke on X one time where someone said, there was an ancient tribe in Native America where an ancient Native American tribe where they used to think that the world was created on the back of a turtle. And so a woman inquired, it's like, oh, okay, well, what did the turtle sit on then? And then someone got frustrated and said, well, it was just another turtle. And then she said, okay, well, what did that turtle sit on? And then the lady got mad and said, it turtles all the way down. So like, where does it stop? And that's kind of where central banking is. It's like the dollar's based on debt and the debt's based on dollars. It's all cyclical. Yeah, cyclical. Cyclical. Huh? That's not a word. Cyclical. What is the
circular.
world? Yeah, circular. What recursive, I guess you could say. But that's how central banking is. It's all like based on vapor. It's a bit frightening when you actually think about it. But I forget where I was going. What were we talking about? We were talking about central bank plumbing. And
the 10-year yield.
Yeah, the 10-year yield.
Now the Fed has committed. I think they're buying $40 billion.
Yes, that's what we're talking about. Thank you. So it's like $40 billion in T-bills. So it's anything that's issued that's a year or less in maturities. They call these things treasury bills. So there's treasury bills, there's treasury notes, and there's treasury bonds. So treasury notes are like 10 years and less. Treasury bills, anything longer term than that.
Treasury bonds.
Bonds. I'm sorry. Thank you. So one interesting thing that's been happening recently, really started under Janet Yellen. And now Janet Yellen was issuing a ton of debt on the short term on treasury, using treasury bills, which was very weird because at the time, the Fed had rates super high, like 5%, 5.25%. And the Federal Reserve rate was at 5% at one point, wasn't it?
In 2022?
Yes.
Okay.
Yeah.
Yes.
So, and then, but we also had 10-year bonds that were around 3.5. So it's like, well, why was she issuing all this debt in a higher interest rate environment? So it really made no sense. I'll let her answer to that. I really don't know what the whole deal was there.
I'll say it a little.
Then, go ahead.
No, you're fine.
Scott Bessent took over and he's doing the same thing. So I actually looked it up, and would you believe that 40 to 60% of Treasury issuance so far in 2025 has all been 2 years or less?
Yeah,
very short maturities.
So let me put this in like some like layman's terms. This is effective. Now, I think what's more strange is honestly not the 2022 anomaly where longer term interest rates were were lower than short term interest rates and they were still borrowing short term. I almost wonder what the heck was going on in 2020 and 2021 when long term interest rates, a 30-year government bond was like 1%. Like anybody that had their head on straight that owned a house in 2020 or 2021 was...
Well, the Fed was still engaging in QE. That's what was going on. So the Fed stopped its QE and then started it again to respond to the COVID pandemic. So that's why the long-term bonds were, quite low.
Yeah, that's fine. But why wouldn't the government borrow that money on a 30-year basis? Why? Well,
that's my question.
That's what I'm trying to point out. Like when interest rates were 1%, would you go and on a 30-year basis, would you go and refinance your house and say, just let me borrow this for 5 years and then I'll take the new interest rate after 5 years. Like I think anybody with their head on straight in 2020 was able to look down and go, gosh, 30-year money at like 2% or less is really amazing. You were able to borrow money in 2020 and 2021 at like cheaper rates than the inflation rate. That's, I don't know if we'll ever see that again in our lives. I hope we don't, because the situations and the circumstances that have to be present for that to happen are not great. Kind of one of these be careful what you wish for type situations. But here's the deal, right? The Fed's dropped rates a whole bunch. The long end of the interest rate curve has not moved. Mortgages have not gotten.
Well, it moved higher.
Right. It depends on where you measure it from. But let's just say it's relatively flat. It really hasn't done much of anything, and so it hasn't brought relief to people on their mortgages, and it's led to this affordability crisis.
Well, I don't
feel like we have.
I don't think this is much of a conspiracy theory. I don't think the intent of dropping short-term rates is to reduce the affordability problem in housing. I actually think that's not even the mission. Now, that might be the political narrative that's painted through the media. But when you look at the past few interest rate cuts that the Fed has conducted, they've actually resulted in higher mortgage rates.
Agreed.
So I think that narrative is false. I think what really is going on is that the net interest expense on the U.S. debt, which is surpassed $38 trillion, $38 trillion total, is higher than the U.S. defense budget. It's approaching, I think it might be surpassing $1 trillion a year. So issuing debt on the short end of the yield curve that the Fed has direct control over, that they can basically monetize without much of an issue, does two things. First, it reduces the net interest expense of the U.S. debt, which makes the spending problem appear less. By the way, the spending in 2024 was like $6.8 trillion. So far in 2025, it's $7 trillion. Doge didn't do anything. It might have reduced a little bit, but ultimately the U.S. has a massive spending problem. But I also think that the Treasury Secretary is a very political position. I know people like, oh, the Fed's independent, the Fed's not political. First of all, the Fed is political. The Treasury is definitely political. Okay, the Treasury Secretary is appointed directly by the U.S. president. So let's get real here. Now, of course, Congress has to approve and all that, but you know how things go. So, the Treasury Secretary, I think, is being used. Janet Yellen, Scott Bessent, they're using more and more short-term debt because it's a way to control the political narrative. You can basically pass a poison pill onto the next administration. I think that's kind of what it's being used as. It's being used as almost of a political weapon, but it's also being used as a way to temporarily reduce net interest expense, which is important for the nation. So, ultimately, though, I think we do need to bleed into or segue into our 2026 predictions. I think we can flesh out the 2025 predictions.
Well, and we kind of have been, because they're really related to these. Because again, what do we predict for the Fed?
Well, what I predicted is that the yield curve will continue to steepen as the Fed engages in not QE. I think they're going to increase their focus on the short end of the yield curve, where most of the Treasury issuance is happening. So I think that the idea is reduce the short end of the yield curve as much as possible. I think they'll let the long end of the yield curve steepen a bit, but I don't think they're going to let it get out of control. So I think next year we'll see the yield curve steepen, but the Fed will ultimately start to baby step its way into actual official QE. We'll call it QE infinity. So that's prediction number one.
Well, let me maybe dive a little deeper into my thoughts on this, my views. So the Fed, they control these interest rates to try to manage two things. Mm-hmm. The Fed has what's called a dual mandate. Mm-hmm. And dual mandate means that there's two things that they try to control, one being the labor market, the unemployment rate, and the other being inflation. Mm-hmm. And so at any given point in time, you're going to see the Fed reacting to one of these two stressors. And they have to make a call as to what's most important here and now. And I think this is really where the Fed's at today. And I think in 2026, it kind of could be a little bit of a toss-up. So to paint the picture here, the last Fed interest rate cut, we had a 1/4 point cut. So the Fed reduced rates by 0.25%. Now, the Fed has what's called dissenting member. Like if you're a member of the Fed and you don't agree with what the board is doing, you can dissent. And so you can say, hey, I don't actually support this. Here's what I would have done. We had two people that said they would want to raise rates and one person that said we should have cut them more. Mm-hmm. And as kind of observing this, what I'm noticing is that really which one you want to do is boiling down to whether or not you see which thing is the greater problem right now. Like, is inflation behind us? And do we, are we done worrying about inflation? And the way that they worry about inflation is they keep rates higher to try to restrict the economy and dampen the impact of inflation. Mm-hmm. Or we just got a jobs number out this morning. Unemployment rates ticked up to 4.6%. That's significantly higher than it was at the beginning of the year. So is it time to not worry so much about inflation and focus more on the labor market? And I think this is going to be a key debate amongst the Fed in 2026. And then on top of this, you have a new Fed chair. So we've had Jerome Powell now since I believe 2018. He's been the Fed chair for a while.
Yeah, this is last year, his final term.
And he's out this next, I think it's May.
Mm-hmm.
So Trump is going to appoint the next Fed chair. Now, up to last month, people were pretty confident it was going to be Kevin Hassett, who's Trump's economic director. The problem with that, and so like we have all these prediction markets. These are kind of new, relatively new things. You get like Kalshi and all these Poly Market and such. These are platforms that exist for people to kind of bet on what they see as the outcomes. There was like almost an 80% chance that Kevin Hassett was going to win. Then you got all this like pushback. Like Trump actually came out and said, I know who it is. And everybody thinks it's Hassett. And there's a ton of pushback because Hassett's kind of seen as a Trump yes man. And there's this other guy, Kevin Warsh, on there. And so then Trump comes out and says, I like the Kevins. So now nobody knows if it's Kevin Hassett, Kevin Warsh. And the thinking is that the Trump administration has been pushing back on Trump because people are worried about Trump putting somebody in the seat of Fed chair that's just seen to be a puppet of Trump. So this all ties back to the 2026 Fed predictions, because what I think is going to happen is I think we're likely to get a new Fed chair. I think
that's inevitable.
Well, yeah. So I shouldn't say that. We're going to get a new Fed chair.
Bold prediction.
Yeah. I think we're likely to see somebody that's more dovish than Powell. I think that we're going to see over the next 6 months that inflation. So I noticed this morning, oil dropped below $55 for a barrel. First time in a long time. By the way, it was up over $120 a barrel, I think, when Russia invaded Ukraine in all those years ago. Now it's down $55 a barrel. You have rents. You and I both looked up essentially rent growth year over year, new tenant rents. They have dropped dramatically since last summer.
I would be careful at saying that. The pace of the rent growth has
slowed,
dropped, but it's still positive.
Yes,
year over year.
but just like inflation, like one thing we're going to talk about here is that I think what most people want when it comes to inflation is prices to drop. And that's actually not how inflation generally goes away. Like if you had inflation at 0%, that doesn't mean that prices go down. It just means they don't go up. And so here we go, like looking at housing, I think, yeah, okay, they're still going up, but they're going up at a much slower pace than they were before. And housing is a huge component of the CPI. And housing is a rearward looking indicator in the CPI. We look at housing basically as people are turning over their leases, which tend to, if somebody's in their lease for 2 or 3 years, they can get a pretty big step up when they turn over the lease. So the impact of looking at leases raising is kind of a lagging effect. So
I don't mean to dispel the whole notion of the PCE, which is what the Fed looks at. The Fed looks at the personal consumption expenditures index. They don't look at the CPI. Housing is only 18%. They utilize something called owner's occupancy equivalent, renter's equivalent, which is this cockamamie formula where they take 40,000 households and they kind of try to map over, okay, what would this house rent for? So they don't even look at the prices of homes. They don't. They look at what those homes could rent for. I think that, forgive my colorful speech, I think the whole PCE housing component is bull crap. I don't.
Well, that's kind of what I'm saying.
What people care about, can I buy a home? They do not care about rents.
And you know what one of the biggest drivers of not being able to buy a home would be being unemployed. And so this is kind of my argument, is that I think that the inflation numbers we're getting are rearward looking. I don't think they're fully capturing some of the deflationary pressures that are out there. Maybe, I don't know if deflation is the right word, maybe disinflation, less inflation than before. And I think the labor market is quietly telling you that there's weakening that we should pay attention to. So I tend to think that next year we're going to have the opposite effect. For the last couple of years, we've talked about the Fed dropping rates more slowly than expected. I think next year we're actually likely to see a quicker drop than expected as the Fed will turn away from inflation as that starts to look more manageable, and they're going to pay a lot more attention to employment. I think that's going to drive them to cut the rates.
Well, I mean, they're going to cut the rates. I think they're cutting the rates is inevitable because they need to cut the net interest expense.
Cutting the rates more than they're saying. Like right now, I think that the market's priced in 1 to 2 cuts next year. I think we could get more than that.
If we get a Hassett, yes.
I think even if you get a Warsh.
Yeah, I think it's more likely than not, and that's why we're predicting this. So, but ultimately, I don't buy the notion that it's going to do anything to fix the affordability crisis that we have. Now, by the way, I wouldn't really call it a crisis. It's just an issue.
We have to get wages up. I mean, the way you fix this affordability problem isn't by bringing prices down. That's actually like if you look at those kinds of events historically, they're not fun events for anybody. What you need to do is you need to keep wages rising.
No, I think prices should come down so long as it still can. So long as companies can still maintain profitable margins. This idea that deflation is bad. Everybody looks like, oh, look at 1929 and 2008. It's like, yeah, those events were bad. People became suddenly unemployed. But also look at how deflation has actually been the law in the technology industry. It is so long as a company can provide products and services at a steady declining rate, providing more and more value to consumers, but do so profitably.
Yeah,
that's really the magic formula.
I'm not so worried about companies making less money because the price of their products goes down. I think that if you took the value of the housing market in the U.S. and dropped it by 20%, I think that reflects trillions of dollars in the pockets of potential spenders. And one of the reasons that I think that the economy has a little bit more insulation or resilience than people expect right now is that if you look, and I know people complain about home ownership. I'm not trying to, this isn't really a dog on the people that don't own houses, but if you do own a house, you inevitably have a lot of money in your pocket right now. There's just not a lot of houses that, if you've owned your house for more than a few years, you're sitting on a pile of money, and slowly but surely you have the ability to spend that pile of money. And this is why 2008 was such a problem, was because houses are one of the most impactful assets on the balance sheet of consumers. So I kind of agree with you that like the price of a TV going down isn't really the big concern. But if you take the value of people's retirement accounts, the value of people's houses, and you give them 30% haircuts in those places, they're going to pull in their spending. And that's going to be really not fun for the economy. And it's not about, the margins on a TV. It's just about less TVs getting sold.
Yeah. Maybe. Now, this kind of ties into our second prediction, which I think that the midterms are next year. And I think that because of this affordability issue, and it's really not an issue that I think any government administration can solve. I think it's a fundamental, what do you say it when something's structural? There's a word, it's escaping me. It doesn't matter. I think it's just how our economy's built. The wealthy get wealthier. I think that, if you're living paycheck to paycheck in a fiat driven economy, where the government's, chronically running deficits, I just don't think that there's much of a chance that, wealth inequality is going to tighten. I think it's only going to broaden. And as such, I think the House swings blue. I think the Trump administration has campaigned on this idea of cutting spending, increasing wages broadly. The Trump administration doesn't have control over things like AI, which I think is really what's behind a lot of this, companies not hiring. Plus, the whole tariff policy, which is that's the linchpin for the whole, increasing wages in the United States. Like, if we increase tariffs on Chinese products, that's going to motivate companies like Apple to build it here, and, of course, if the tariffs get mothballed, that undermines that entire policy. So, and at the same time, you got AI happening. Wages just aren't increasing. In fact, wage growth is decelerating. It's not accelerating. So this all culminates into an affordability issue that lower interest rates is just not going to solve. So going into the midterms, I think the Republicans take it on the chin. We're going to see the House flip.
But I want to put some data to something you just said, okay? Because I just pulled up here wage growth in the U.S. compared to the CPI. And so I'm not disagreeing with you that fundamentally, like, people are upset about the costs of things. I guess what I'm wrestling with is, like, how much is this actually, how much progress are we actually making, and how much of this is kind of the stickiness and the almost hatred for these high prices. You know, there's a saying in our business that the cure to high prices is high prices. Basically, it says that when prices get high enough, people get pissed off and they stop spending their money. So I just want to point out that since the end of 2023, I graphed the growth of wages and salaries across the workforce here in the U.S. as compared to inflation. And inflation is measured by the CPI, and we've talked about the CPI, whether it's right, wrong, whatever. But as measured by the CPI, since the end of 2023, prices have increased by, let's just call it 5%. Wages, on the other hand, have increased by 9%. So that's a 4% catch up, so to speak. And I do think that as long as we can keep, or the Fed, I say we, you know, we've got this kind of collective economy but as long as the labor market stays healthy and wages can continue to outpace inflation, slowly but surely over time, you can get affordability without having to bring the cost of groceries down 30%.
Well, slowly but surely is not on the side of the administration, I'm afraid.
Yeah, and I agree with that. But the data is definitely, like, if I were
the people don't care about that. Nobody, the CPI is bogus. Like, nobody cares about
wages
the CPI.
Over the last 5 years. Okay, and for the first 2 years of this 5 years, wages grew in line with, but wages have grown by 33% with inflation at 24%. Okay. Measured by the CPI.
Well, so, here's the problem with that statement. It doesn't apply to most people, because what you're looking at is the average, not the median. All right. So most people would probably agree with this statement that I'm about to say, and that is prices have outpaced my wages.
Over what period of time?
I'd say over the last 5 years, over the last year, over the last infinity. I think that's what they're going to say. And perception is reality. You could show this chart to people all day long. It doesn't matter. If someone is, let's say, a stock worker at Costco, they're not earning a wage that can afford them a 2,500 square foot house.
Well, I think Costco is a bad example because they came out and raised their minimum wage to $30 an hour.
That's not enough. That's not enough. You cannot
look.
You cannot afford a $500,000 mortgage.
We can argue over whether $30 or $20 an hour is enough, but Costco is raising their minimum wage from $20 an hour to $30 an hour over a couple of years.
And I'm glad to hear that.
That's what we're not talking about absolute wages. We're talking about relative change. And so increases, whether you want to cherry pick bottom, jobs at the lower end of the economy, the up end, all we care about is net change. Yeah, okay, it doesn't buy you a $500,000 house. There are $300,000 houses out there. I realize the median price of a house is not $300,000, but there are different houses. And I don't want to come across.
But that's all going to tie in. That's why consumer sentiment's so low. My whole, again, like, I'm not trying to make any point other than that I think the house swings. All right, that's the prediction. And I'm saying that based off of the sentiment and the median voter out there. We're not talking about the top 40% of society that's doing quite well. We're talking about the bottom 60%, which they all have equal votes as far as I'm concerned. I think that the sentiment doesn't shift. I think that the problem is this wealth inequality that is only going to get pronounced. I think that the issue is structural. It's just how our economy is built. That's a whole nother podcast episode perhaps we can talk about. But, second prediction is that I think that we end up with a lame duck president the next 2 years. Some people are going to hate that. Some people are going to love that. So we'll just see how that shakes out economically. The other thing that I think this ties into, let's see here. We said the yield curve steepens. We said, the other thing that ties into is I think that next summer. We've mentioned this, and I think the Supreme Court does rule against the Trump administration's use of the International Economic Emergency Powers Act to implement its tariff policy. I think they deem that as unconstitutional. Now, that's not the only arrow that the Trump administration has in its quiver, but it's the most precise one. So what this basically means is that the $200 billion, or how many billions of dollars in tariffs that are collected between now and next summer, it's going to have to be returned. So that's going to have a couple different effects. One, now the reason why I'm saying that the Supreme Court is likely to throw this out is because during the verbal arguments, Roberts and Gorsuch, which are conservative leaning justices, they kind of implied in their their oral judgments that or their oral arguments that they would be inclined to deem it as unconstitutional. They basically didn't look at the Trump administration's arguments as being favorable. So I think that there's a significant likelihood that they're just going to mothball the whole thing. So what does that do? If you're Tim Cook at Apple, you're going to look twice at building that $500 million facility in the United States. You might just wait this out. So I think it potentially could mute wage growth further in the United States as some companies put the brakes on adopting or moving overseas operations into the country. But I also think that it's going to insert a lot of volatility in the stock market, because now that kind of changes the whole valuation of the stock market. It's like, well, all this the tariff play, which I don't really know if it ever quite truly panned out. This idea that U.S. markets are out going to perform international markets never really happened. In fact, international markets outperform U.S. markets year
for the
over
first
year.
time in a long time this year.
Yeah. But also, too, one could look at that and just say, well, that's the weak dollar, because the dollar has weakened against the DAX about 10%. But also valuations overseas were just much more attractive. So, one could argue that U.S. markets actually did very well relative to international markets, with all things being considered. But you could see like the reversal of like the U.S. equity premium as a result of that. It also ties into one of my other predictions, which I think we're going to see. We already saw this year, China stock market rebounded. I think next year that's going to continue. So we're going to see the reemergence of China. Did you know that U.S. Exports from China only represent 3% of Chinese gross domestic product?
Huh.
It's actually pretty small. So a lot of people are like, oh, U.S. tariffs are going to cripple the Chinese economy. It's like it's barely even a rounding error for them. So it's just not a big deal. So China is the reason why I think China is poised for rebound is because they're doing an unprecedented amount of stimulus in the economy, in their economy right now. Now they do have some demographic issues, but I think that the Chinese stock market's been hated a little bit too much. So let me think here. What else do we got on the docket here?
Well, I think one of the things that to me, we talk a lot about not timing markets, and I don't want to speak out of both sides of our mouths, because I do think it's important that you stay invested. And there's this notion that in investing, the market climbs a wall of worry. I tend to think that the market's pretty. There's a lot of worry in the market right now between. Just to recap on some of the things that have happened lately, we had Microsoft. There was a Microsoft story where two of the salespeople came out and said the quotas for some of their AI products got cut in half. You had Oracle do a deal with OpenAI that was debt financed, and the investors of the debt basically bought a ton of insurance because they're worried about the viability of that debt long term. I mean, you have some things that have happened more recently that have got the market a little bit spooked, in particular around the AI trade. And so I think that, like, for me as an investor, I kind of, I don't want everybody to be super excited about the stock market. When everybody is excited, I don't know where we're going to find the next buyer. Everybody's kind of bought in. But what I feel is that there's a lot of people that are still nervous. And to me, that means that positioning probably has like people could buy more stocks, and as some of these things come together, there's a likelihood that they will. But I think a lot of this hinges on next year. We really need to see, or at some point here soon, we really need to see this AI trade broaden out into the rest of the market.
Mm-hmm.
If a company like JP Morgan Chase or GE or Procter and Gamble, some of these boring, what we call value companies, can't take AI and use it to make their businesses more effective and profitable, then I think it's going to start putting a lot of pressure and challenges on like whether or not these large tech companies should be spending all of this money to build out the AI infrastructure.
Mm-hmm.
And I think the risk to the market right now is that if you had an AI company come out and say, well, we had these grandiose spending plans to build out all of these, this AI infrastructure, and now we're questioning that and we're going to start pulling back on spending. Like, I think that could be kind of the canary in the coal mine that takes a lot of the wind out of AI. So if we're going to avoid having that happen, I think that AI has to really prove to be economical.
Mm-hmm.
And for that to be the case, it has to improve the efficacy of some of these non-tech companies, smaller companies, things like that. And hopefully, people that are watching the AI, more recently, we got like the application of agentic AI. And so now there's these AI agents that hopefully will continue to get better and be able to come out and do tasks. So it'll just be interesting to see like how much work can these AIs really take over, and what does that mean for their value? I mean, because, I can hire an employee to do the same thing. So the AI, maybe it's worth a heck of a lot if it saves me hiring the employee or it makes me more revenue. But if it doesn't save me cost or increase revenue or increase profits in some way, why am I going to pay for it?
Yes. What I've found just being a business owner myself, now granted, I have a small, tiny business compared to a lot of these companies that are these hyperscalers. What I find difficult about AI is actually implementing it. It's not a magic bullet. There's this idea that you can AI will do it all and it'll do it for free. It's ridiculous. It costs a lot of money to train an AI process that can automate things properly. And then you ultimately can't rely on it because it's not, these things aren't 100%. When they perform errors, the errors are pretty critical. You always kind of need a human being to police these things. At least that's my experience. Maybe someone who's a little bit more adept in implementing AI, can correct me on these things. But as a small business owner, not seeing a lot of ways that I can apply AI in ways that massively reduce costs. Now, I do see the potential for it down the road, but I think that there's just a huge shortage of people that are trained on how these AI systems can be adopted and implemented. So basically what we need are just a bunch of really smart software engineers that can come into the enterprise, identify those areas that can be replaced by AIs. Like where are the bottlenecks? Where are the redundancies? How can we eliminate those with a more efficient like AI process?
And I think we're getting closer to that put up and shut up moment.
Yes, exactly. And your point is the value companies, the Procters and Gambles of the world, the GEs of the world, where is the value in it for them? What justify why they should be spending millions and millions, billions of dollars in CapEx to roll out these AI systems when it's not going to result in additional inflows for them. So I think that 2026, and I agree with you, that our prediction actually is the AI trade fractures, where we're going to see less momentum in these hyperscaler names. Now, we're not saying that the revenue is going to evaporate. We don't know. That's the unknown. What we're saying is that next year is the put up or shut up moment, where we're either going to see one of two things. We're either going to see value stocks implement AI in very productive ways. That's going to improve their earnings, which is going to then take the AI hyperscalers off this circular financing, mechanism that they have going on, which is unsustainable. You can't just continue grow your earnings with everybody just, these hyperscalers just promising each other revenues, which is what's happening right now. It's like, it's like that Spider-Man meme where, they're all pointing at each other. Yeah, that's what's happening right now. So ultimately they're gonna need to find an end customer, and the end customer ultimately terminates to you and I. How is this delivering value to you and I, Brent? And right now everybody's like scratching their heads wondering, how am I going to buy things if it's replacing my job? It's like, well, who are these things serving at the end of the day? That's why I don't really buy the idea that these things are going to replace everybody's job. In fact, I think the opposite. I think it's going to be like email. Remember when email came out? Well, you probably don't remember this. I don't really remember it, but it was supposed to be like this, we're going to have this influx of efficiency in American business, when in fact, like every day, like half of my day is dominated by emails, responding to emails, reading emails, processing emails. It's, it actually it's increased my workflow like tenfold. So I think AI is possibly going to do the same thing, where now it's possible for you to do quite a bit more because it makes your research function much more efficient. But it also creates a lot more work because now there's a lot more fact checking involved. Like did it produce the right result? Let me fact check that. Oh, that doesn't look a little bit right. Let me fact check that. So, I find AI to be incredibly useful. It increases the value I provide to people, but it also increases the amount of work that I'm doing. I'm finding that to be true. So now maybe that's not always true, but I think ultimately AI does not replace people. And I do think it's going to end up providing value when it's implemented correctly. So I'm optimistic. And I think that, yes, the AI trade will fracture next year, but that does not mean that it's a bear market. What that means is that we're gonna start seeing some obvious winners not winning, and we're also going to see some we're going to see some companies that haven't been winning, and we're going to think all of a sudden they're going to be winning, and you're going to think, well, isn't that obvious?
Google.
So yeah, well, Google is one of those companies that it's been the AI play this year. Everybody came into 2025 thinking, oh, this is going to be another year of NVIDIA. And in fact, NVIDIA's done well, but in fact, I don't know. What's NVIDIA up year to date?
Google is the best performing AI stock year to date.
62%.
It's such an interesting one because this time last year, everybody was talking about the death of the blue link economy. Like how is, when everybody goes to ChatGPT to ask their question instead of Google, and Google can't get the ad revenue of pushing you the sponsored links at the top, how is Google going to survive? And now Google's managed to change that narrative to be that they're the only AI player not dependent on NVIDIA. And so anyway, I mean, Google's really been a huge turnaround story. And I think it's a great example as to why you shouldn't get too caught up in the short term and in terms of performance and whatever the narrative is with any given stock, because narratives can change. And, this year we've seen Google's narrative go from the clear loser and how's Google going to handle this to the best performing AI stock of the bunch.
I remember the narrative going into 2025 with Google was the Google search was going to get cannibalized, and ChatGPT.
That's what I'm saying.
OpenAI.
The death of the blue link economy.
Oh, is that what okay.
Yeah, the blue link economy is the Google search.
Yeah.
Right? What happens when you Google search? You get a bunch of blue links. And, they getting to the top of Google has been a massive moneymaker for Google for years and years and years.
Mm-hmm.
So what are they going to do? And anyway, it's just fascinating. So we'll be excited to see what really happens next year and how everything plays out. I think from our perspective as advisors, if we're looking down at portfolios, we really want to make sure that concentration is limited. We want to make sure that you've got exposure to other areas of the stock market besides just the AI plays. A diversified portfolio, we feel, is going to be more important than ever as we kind of tread through these next few years and have to manage inevitable uncertainty.
Yes. So, uncertainty is the only thing that's certain, right? That and death. But yeah, I want to recap these because I think that we're all over the place with them. And for the listener that's made it this far, I could do you that one convenience here. So the first prediction I think we called out was that Well, actually, yeah, it was the yield curve steepens. So I have it last on the list here, but it was the first one we touched on. So we think the yield curve steepens as the Fed engages in not QE. So they're going to focus on the short term of the yield curve, mostly just to address blowout deficit spending. Then we also believe that the House is going to swing blue. The Senate, I'm less certain about, but I think the midterms are ultimately going to fall to not favor the incumbent. We think that the economic emergency or the International Economic Emergency Powers Act that the Trump administration is using they're no longer going to be used that to implement tariff policies. So the Supreme Court, I think they're going to torpedo that. We think the China market continues to Chinese stock market. And by China, I'm going to say like emerging markets in general. I'm just going to expand that definition a little bit, but specifically China, I think is going to continue to have a rebounding stock market next year. I think that the broad, we said the broad stock market is going to do well. I think next year will be a good year for a diversified portfolio. So one that's not concentrated just in U.S. growth, which has been the play the past few years. So it'll be a good year for a more diversified play. Let's see here. And the final one is the AI trade fractures. So, actually that's pretty much what I just said, right? So yeah, that summarizes.
Thanks for your articulate recap, Ben.
Yeah, do the best I can. It wasn't very good, I'll be honest.
Well, with that note, it's very important. I mean, we joke about these predictions, but in reality, a good advisor knows that there's always room to be wrong, and you don't want to build investing is not betting, and we don't want to take your financial success, and you shouldn't want to take your financial success and plow it all into one thing that assumes that you couldn't be wrong. So we are very willing to be wrong on these things, but we hope you enjoyed our banter, and that's how we see the world as it is today. And next week is Christmas, right? Holidays. It's Hanukkah right now. We've got Christmas. So what do you?
I think this is the last episode of the year, if I'm not mistaken.
Yeah, right? I think it is.
Yeah. So we've got.
So then we've got to have an episode on how to plan for the new year.
Technically, we're recording on the 30th, but that's not going to come out until the new year. So we will have an episode at the new year for you loyal listeners. No tip of the week this week. Normally we come up with a tip, and today we were so just invested in getting our predictions, getting thoughtful predictions down on paper that we neglected to do that. Did you have anything off the top of your head?
Well, I would just use this as a moment to kind of plug year-end planning. With our clients, one of the things that we focus on this time of the year is getting tax projections in place. So we're actually actively looking at each client's tax situation, getting a sense on whether they should decelerate or accelerate income. I think one of the most probably underappreciated area of financial planning is year to year, really understanding where is your tax situation, where might it be going, and is there any strategic way to change that? And we have a podcast on tax planning. I'm sure we'll put out other podcasts on tax planning, but if you have any questions, certainly feel free to reach out to us. We would happily find a way to help you with some of that planning.
Yeah, we'll make sure all of our contact information gets plugged into the show links. So if you wanted to reach out to Brent or myself, just pull up the show notes, and we'll be happy to field any questions that you have.
Thanks for listening.
Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.